we're going to be talking today about some simple swing trading strategies for the S&P 500. I'm also going to talk about how to enhance those strategies. I'm going to go into a little bit more detail on the processes I use and some of the things I think about when swing trading. So I'm excited to go through it all. Now that I can see that the questions box is working for me, I'm going to save time at the end of the presentation for any general questions, but as I'm going through the presentation, if there's something that I'm not clear about or something that you want more detail on that I'm referring to at that point, feel free to go ahead and ask. I don't mind at all addressing questions throughout as long as they pertain to what I'm talking about at the time. Makes it a little bit easier when we're doing one of these over the internet rather than face-to-face. Face-to-face, I can see people's reactions and I can answer questions quite easily when I know that they're there. On the internet, I can't see anybody, so happy to interface with you during the presentation as well. All right, that said, let's get going. This is our standard risk disclosure statement. If some of what I'm going to be sharing today is back-tested information, I have used back-testing and historical analysis for a very long time, and it's helped me to learn an awful lot about the market. So that said, it's not perfect, and there's no guarantee that things will work the same in the future as they have in the past. They just we just get hints into how the market is likely to work by doing some historical analysis. And there's obviously always risk in trading. If you have traded for any period of time, I'm sure you've had a losing trade. So there are winners and losers. Renee gave a nice introduction about me, and I think she went through basically all of this. So I'm not going to spend a whole lot of time on it. Happy to answer questions if you want about me. Probably better towards the end, but I've been at it for quite a while, and I've written for a number of different places, and I've presented at numerous conferences over time. So you can Google me and find me all over the internet. All right, so we're going to talk about two simple but effective swing trading strategies, and then I mentioned earlier in the title slide how to improve them. Okay. I'll come back to this slide at the end of the presentation as well, but I do write a nightly newsletter, and that comes, it's called the InvestQuant Swing Navigator. You're welcome to get a free trial of it by going to that site. All right, this is an example. This is the SPDR. It's the ETF for the S&P 500. And I have a swing trading system up here. And generally what the system's looking to do is it's looking to buy oversold and then sell into overbought conditions. All right. And you can see that the parameters for the system have worked out quite well over most of the time here. This is a chart from, I think it's actually from a couple of years ago, but I liked it because, and I haven't changed it since, because it shows a number of winners, and it does show one fairly sizable loser there. But throughout, it's done a pretty good job of buying dips, buys the dip here, sells here, buys the dip here, sells up here, buys here, sells up here, buys here, sells up here. So this is generally what you want your swing trading systems to do. You want them to get in when there's a favorable opportunity, and then get out a few days later when the edge you have, or the edge you initially had, is no longer as prevalent. Sorry, it looked like the question box was, I shrunk it too much. All right. So we're going to go in, and I'm going to explain to you exactly how that strategy that looks so good on the chart was done, and it is, as I said, simple. I call it my 5-day low, 5-day high strategy. and I will share all the rules with you for that strategy right here. The entry rule, we're looking for 5-day closing lows in SPY. All right, so if today ends up being the lowest closing price of the last 5 days, we're going to look to enter long tomorrow morning, and I'm going to use a limit order that's equal to today's closing price. In other words, if we get a gap down tomorrow morning, I'm in at the open. If we get a gap up, I would be in, or the system would be in, once the market pulled back to the closing price of yesterday. If the market does not pull back to the closing price of yesterday, and it leaves an unfilled gap up, then no trade is taken. It's not chased. Okay, so we're simply looking for a 5-day closing low and then looking to get in at the next day if we can get a favorable entry. The exit rule, even simpler. Here we're looking to exit if today's closing price is the highest closing price in a group of the last 5 days, meaning today and the previous 4 trading days. All right, so if you look back at what the high was over the previous 4 days, that's your exit target for today. At the close, you can use limit on close orders, or you could simply execute around the close on your own manually. Here's an example to walk through in case anything wasn't clear there. We have on day 3 here, on day 2, you're actually closing at a 5-day low. All right, so on day 3, we are looking to enter, and this trade entered on the gap down. At the end of day 3, it was a slight loser. At the end of day 4, it was a small winner, but it was not at a 5-day high. At the end of day 5 here, it closed at a 5-day high, and the signal would have been exited. Okay, assuming everybody understands the rules. Yeah, I do believe these slides will be available for download, or at least you'll see it on YouTube. Now that you understand the rules, let's take a look at some of the results here. Oops, that was a quick look. Sorry, I'm trying to shrink down the chat box so I can see my own screen a little bit better. So over the period of 2007 until now, this very simple system that's looking to buy after 5-day lows and sell into 5-day highs would have been profitable about 71% of the time on 170 trades. Okay, profit factor is something I'll refer back to later, but as an explanation, it's a metric that system traders use, and all it's doing is dividing the gross profits, in this case 179,000, by the gross losses, 115,000, for a number of 1.55. The reason we do that is if there's 2 systems that people are evaluating, so they both made $10,000 over the same amount of time, one system made $10,000 by having 20,000 in gross profits and 10,000 in gross losses, that would be a profit factor of 2. And that's considered quite good, actually, most of the time. If another system had the same $10,000 in net profits, but it came with 100,000 in gross profits and 90,000 in gross losses, that's generally viewed as a less desirable system. You got to fight through a lot of losses to realize that $10,000. So that would be the 100,000 divided by 90,000 gives you a profit factor of 1.11111. In any case, here we see it's got a pretty solid profit factor of 1.55, total net profits of 63,000, plus it's been in the market 1,003 days out of about, you're looking at a 10-year period, we 2,500 days, maybe 2,600 days because it's 10.5 years here. So that's about 40% of the time that it's been in the market where you've been after a 5-day low, it's taken a few days to get back to the 5-day high. It's not showing the average number of days that it's in. All right, here is a profit curve. So it did see some struggles here. This was during bear market, and it did see some struggles here. But for the most part, it's trended higher. It's at new highs. It's gone from lower left to upper right. That's the direction you want to see when you're looking at profit curves. So it's been a fairly effective system, all right, for a simple system buying pullbacks. Now, it's not necessarily my favorite system to trade, and I'm not sure many people would actually find it completely tradable on its own. And I'll get into how to improve it a little bit later. But there are some things in here that make it a little bit difficult to trade. The number one thing, in my view, is that a 5-day low for a lot of traders can be a scary time to buy, right? If you're moving down to a 5-day low, and sometimes it's going to be more than a 5-day low. The 5-day low could also be a 20 or a 30 or a 50-day low. The sell-off is often happening on bad news. So are you capable of buying into bad news? Some traders are, and some traders aren't. And then you need to hold on until you're back at a 5-day high. So there will be some, your timing's not going to be perfect every time, and there will be some dips after you buy. And so it takes discipline to be able to hold on. Therefore, it's nice to get confirmation from other areas. And I'll show you one way that I look for confirmation later on, okay? Before we get to that, let's talk about a simple seasonal strategy. So we've got a 5-day high, 5-day low system. It's actually pretty good. Would have done quite well over time with a decent profit curve. But as I hinted, I think we can improve it. Here's a simple seasonal strategy for you. And what this is doing is looking to take advantage of the bias that the market has had over the years to move higher around the end of a month and the beginning of a new month. Okay, so here what we're doing is we're looking for it being the first trading day after the 24th of the month. So in this case, the 24th fell on a Monday. The 25th would qualify for rule number 1. So today would be the first day after. You're looking to buy the S&P 500 at the open the next morning. So that would be on the 26th. All right. So why didn't I just say by the 26th too much? Because weekends mess it up, right? So if the 24th was on a Friday, then the first trading day after would be 25, 26, the 27th, and you'd be looking to buy on the 28th. All right. That buy is entered at the open, as I said, the first trading day after the 24th of the month, and that position is held until the close of the first trading day of the next month. All right. So you're going to hold through the day, the first day of the month, and you're going to sell at the close. It appears I have questions. I've been trying to pop out the question box. Oh, I'm sorry. Richard was asking, I think there's a reference to the 5-day high, low 5-day high system. If it goes against you, is there a stop loss? Not on that initial simple system. So you saw what the results would have been without any stop loss. But certainly you could use stop loss techniques to enhance the system on your own. Does this system work in other markets besides SPY, like ESYM? It should work on a lot of markets that have a tendency to oscillate. So you'll, yeah, YM, I would think it would work pretty good. The trendier the market is, the less overbought, oversold type systems work, and you'll want to go with like breakout systems if it's a very trendy type market. the S&P 500 has tended to be a good oscillating market over the time because it has a lot of different push and pull within it. There's different sectors, you know. You might have people selling off the banks and buying energy, or vice versa, or selling consumer discretionary and buying into tech. And all that causes push and pull within the S&P 500, so it does tend to oscillate quite well. Rich, I thought I had the max drawdown on there. We can go back and look in a little bit. Oops. All right, so actually, let me check it quickly. I did not have max drawdown on there. We'll have to, I'll have to get back. You can send me an email if you want. I can shoot you the answer on that. But you can see it in the profit curve there. There was, what's this, 10,000, almost negative 10,000. So probably 20,000 in drawdown at its worst during that bear market. Okay, there's a simple seasonal system. Again, buying the first day after the 24th, exiting on the first day of the new month. Let's see how this has worked out over time. As you can see, we've got about 60% of them have made money, 1.4 profit factor, so that's pretty good. Average trade made about a little over 1/4%, with the average winner making about 1.5%, and the average loser also making about 1.5%. All right. Commissions are included in both of these systems and in all the ones I'm showing you. Let's take a look at the profit curve, which is pretty good. Again, going from lower left to upper right. That's what the direction you want to head. It hasn't been, there have been flat periods here or periods of moderate drawdown, but for the most part, the end of month seasonality has been a fairly steady edge over the last 10.5 years. So it's something that traders may want to pay close attention to. All right, they're both pretty nice looking as far as the numbers, the profit curves. They both certainly, in my view, suggest an edge, but is there a way that we can improve them? So one of the things that I do at InvestaQuant is we've created what we call our swing edges, and they look at they use a number of concepts to determine odds of the market moving up or down the next day. And I want to share some of those concepts with you before I get into it. Any further looks at performance. So acceleration is the first concept. We have 3 acceleration type systems, but the concept behind them is we look at how fast is the market moving and from where is it moving. So if we have a strong move lower, and it's, in this case, it's coming out of a long consolidation, that'll mean one thing for the market. If we have a steady trend lower and then a sharp move down, or a steady trend higher and then a sharp move down, that might mean something else. And I used to go through some real details on this. I didn't think I'd have time today, but if you look at, for example, a 1% decline in the market, right, on a one-day sell-off of 1% or more, if that happens following a 50-day high, that's generally doesn't provide an edge. It may suggest a slight, you'll get a little bit more of a sell-off. If it happens after a 50-day low, then you get a 1% down day. That suggests a pretty good chance of a bounce in the next few days. And if it happens between a 50-day high and a 50-day low, then there's more of a moderate bullish edge. So you go from neutral to moderately bullish to strongly bullish, depending on where the move is originating from. I'm going to come back to some of these questions I'm starting to see now. They are good questions, but let me tackle them more towards the end so I can get through. I don't want to get too distracted. Acceleration. So that's the concept behind acceleration. The other concept we use a lot is momentum. All right, and that is how persistent has the move been over the last few days and weeks? How strong is the movement? And where is it trading in relation to the longer term trend? So this particular chart here shows is one that has strong upside momentum, right? It's been moving higher for an extended period of time, and it's looking like it's continuing higher. There's strong downside momentum, and there is, if you're chopping sideways, then you've got very little momentum. So when we look at momentum over the short, and we look at it from a short and longer term perspective, that also gives us hints about what we're likely to see happen over the next several days. And seasonality, we already looked at one seasonality system, but there are lots of seasonal forces that can be in play, and that can be time of the year, time of the week, time of the month, certain holidays. I'm going to give an example later on about Fed days. So there's a lot that you can glean from seasonality as well. All right, so what we do is we show historical odds over 3 time frames at InvestorQuant, and those are the 1 day, the 3 day, and the 5 day. All right, so we're looking at a swing time frame. What are the odds the market's going to move higher over those time frames? And we'll show the potential win rates and profit factors over the next 1 to 3 days for anything that we publish odds on. So there's about 250 to 300 securities that we currently publish odds on. About, I think it's 58 ETFs, several futures, and then all the biggest stocks in the S&P and NASDAQ 100 that have enough history. Okay, and basically what we're looking to do is identify when there's a clear short-term directional bias. All right, so what if we combine the 5-day low-high timing strategy with some swing edges data? And that is something that gives me more confidence in taking a trade rather than simply saying, oh, we're at a 5-day low, I'm going in. Right? I want to know we're at a 5-day low, and I've got some other things that are suggesting there might be an edge here. Maybe we've got good momentum. Maybe the acceleration indicators are suggesting that we're breaking out and moving higher, or that we're oversold and about to bounce. And well, actually, in a 5-day low, they're not going to suggest we're breaking out, but they could suggest that we're oversold to the degree that it's likely to bounce, rather than the 5-day lows coming off of a high area or breaking down from an area that is not likely to bounce yet. All right, so this is all useful information that you can use. So let's combine the two. Here, what I did is I said, let's look at buying SPY if it closed at a 5-day low, and our guides for SPY are showing a win rate of at least 55% and a profit factor of at least 1.3. Those aren't real high hurdles, but they're numbers that I've used in the past that have been effective. I've used them for my overnight trading. I've used them for my swing trading. And I've used them for years. In that case, let's buy the next day at the limit price equal to today's close, just like we did in the regular 5-day high, 5-day low system, and we're going to sell either when it gets to the 5-day high or when we no longer have strong odds, right? So that could mean we sold off further and the odds now are against us. It could mean that we bounced some and the odds are against us, or we chop sideways and the odds just aren't as strong anymore. So if the odds are no longer as strong, we're not going to look to take the trade anymore. All right, so it's a confirmation throughout with the system, showing that we either still have an edge or that we don't. In this case, the profit factor moved up over 2, which is great. The average trade went up, total profits went up. Key here is that now you're in the market for 528 days. instead of, I think it was 1,003. I think I show the comparison on a slide in a minute here. And here's the profit curve. So we still have some drawdowns in here, but not nearly as bad as before. And it really is a nice steady move higher for the most part, other than I think this drawdown was in 2011, which was is not surprising. That summer I had several swing systems that struggled a little bit. So here's a comparison of utilizing the 5-day high, 5-day low method with and without swing edges data included as a confirmation. So here we see without swing edges we have 170 trades. With it we're down to 140. So there's not as much trading that needs to happen. 18% less. You're in the market about half the time, as we saw. Net profits are just slightly higher once you add in the filter, but again, you've got less exposure. Your average size loss is lower. The max drawdown went from about 20,000 to about 14,000. So that's a 30% improvement there. And your average trade went up about 26%. So fewer days exposed, more profits and smaller losses. Those are the kinds of things that suggest a useful filter. Those are the kinds of things you want to look for when you're looking to filter a system beyond the very simplest of rules. All right, so now that you have seen how that would work, let's look at combining the swing edges data with the seasonal strategy. Again, going in just because it's the first day after the 24th, or I guess it would be the second day. Today is the first day of the 24th. We're going in tomorrow at the morning. So going in just because we're about to have the end of the month, regardless of what anything else is doing, that's a scary way to enter a trade. And holding without paying attention to what anything else is doing for 4 days or so on average also can be scary. So let's make sure we have some confirmation from the IQ swing edges data. And here, I didn't want to overdo it, so I just said we generally want it to be positive. So a win rate of at least 50% and a profit factor of 1.1. So I didn't want to pull the days in a trade down too much. Here we're looking to buy SPY at the open of tomorrow, just the same. Looking to sell first trading day of the next month, or at the open, the morning after the minimum win rate and profit factor is no longer used. And here we see that the profit factor of the system has jumped to 1.7, about a little over 60% profitable. Net profits have increased. The average bars you're going to be in is going to be lower. Here's the profit curve, which looks quite nice. And here's a comparison. So the number of trades, really not a whole lot of difference. Some months you don't have a trade. Some months you might have 2 trades, right? Because you're in and out with it. The number of days that's invested is reduced by 20%. So really you're in it a good portion of the time. You're getting out of those days where the swing edges data is bearish or neutral. Right, as long as it's not neutral or bearish, you're looking to hold on here. The total profits are increased by about 35%. The average trade is up about 37%, and the max drawdown is reduced by over 50%. It goes similar as the last one. This one's about 20,000. It's dropped down under 10 there. Okay, so again, less exposure, less drawdown, substantially better profits. It's how I like to use it as a filter. Rich is asking what factors are used in the IQ swing edges data. Rich, it's the 3 momentum, 3 acceleration, and 3 seasonality systems. All look at what today's specific market setup is, and then produce odds of how the market has performed in the past under similar circumstances. So it's looking to see for the 1-day acceleration system, what are the odds under similar circumstances, we've moved higher or lower the next day. For the 3-day system, it would be looking at higher or lower in the next 3 days, and then what's the profit factor of buying and holding for a 1-day, a 3-day, or a 5-day period. And then what we do is we average them up. So you want to see good odds from enough of the systems that their averages are showing strong numbers. So that's what the factors are in the data. Let me answer some of the questions before I get into the Navigator studies. So I just want to show some studies from a recent Navigator that are pertinent to this type of thinking and how I use it in real life. But before I get to that, does this work only on daily charts, or can it use in intraday trading? If so, what time charts or tick charts does it work on? Steve Magno was asking. So I believe he's referring to the 5-day low, 5-day high system. That's not something I would normally suggest on an intraday chart. Intraday mean reversion is a lot harder to make work versus daily bar mean reversion. Emotions are involved, and what happens is when the market gets to a place where it's reaching a 5-day low, you've had some type of emotional move lower, causing people to sell out. Sometimes it's in a panic, sometimes it's not necessarily a panic, but nobody's generally happy. And that move lower can gain steam throughout the day if it's happening on bad news. So during the day, you'll have a higher tendency to see something avalanche, right? As you reach, if you're looking at 5-minute bars in the last hour on a strong down day, they're just going to go down, 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 down sometimes. And that's less likely to happen on the daily chart because, well, people have the night to kind of realize, oh, there's been an overreaction. Maybe good news comes out. There's a lot of things that can happen. It's less emotional than an intraday. So I have not found that strategies like that work as well on intraday charts. Have you tested a bear period in reverse, such as selling a 5-day high and then covering at a 5-day low? I have looked at similar systems in bear markets. So if you want to look at a bear market as something like anytime the market is under the 200-day moving average or something very simple like that, yes, you can make money shorting new highs. Not necessarily 5, it could be 10, it could be 15, it could be 20-day highs, whatever it is. Short new highs and then look to get out when the market pulls back. And it may not be a 5-day low. You may be looking at moving averages or something like that that would be favorable to get out. 100K per year. It was 100K per trade that I was doing there, and that was just to keep the numbers even. Okay, so we looked at max drawdown. I don't know what it was on a year-by-year basis, unfortunately. Okay. So I want to go back and show you some studies from this is the Navigator newsletter that I write. This is from 2 nights ago, and some of these studies are very similar to what we're showing in the presentation here today. So I thought they'd be worthy of discussion. So this first one is looking at bullish odds broken down by market position, right? So we saw that when the market's oversold and you got bullish odds, that's been a good thing. But 2 nights ago, Tuesday night it was, I was looking at some fairly bullish odds for the SPY and for ES, which is the futures contract for the S&P 500. But the market was already at a new all-time high, right? So I wanted to see, it was some concern that I'd be buying into an overbought condition. So I broke it down and said, all right, we have strong odds, but SPY is overbought here. So using the same parameters, the 55 and the 1.3%, I said, what happens if we buy after a SPY closes at a 10-day high and we've got good looking odds? Well, in this case, you can see the profit curve is a mess, and our profit vector is not much above 1. In other words, it's the stats tell you what the profit curve is also telling you, right? No significant edge there. It's made a little bit of money over time, but this is not a fun way to make money. So then I said, all right, that's what happens when it's overbought. What about if it's not overbought? In other words, SPY closes less than a 10-day high. Well, now our odds are looking good. So as long as we're not closing at a 10-day high, we got a profit factor near 2. We're right on 65% of the trades. We're showing good average gains and losses, and there's not a whole lot of drawdown here in the curve at all. The worst looks like right around there, and that was recovered very quickly. Okay. And then there's also, we looked at the 5-day low, 5-day high system. I said, well, we know a 10-day high is not so hot. We know if we're below a 10-day high, that's good. What if we're at a 10-day low, right? So what if the odds are strong and SPY is oversold? Well, now our profit factor is up to 3, which is really fantastic. We're right on 75% of the trades. And the average trade is making nearly 1% there. It's 0.9%. So that's a nice move higher. Again, we had a little dip in this period, which I think again was that 2011 period. But other than that, summer 2011, it was a great move up. All right, so these are the kinds of things I think about on a nightly basis. So I'm seeing strong odds. Yeah, but we're pretty overbought right here, right? So let's take a deeper look at, is there a real edge? And in my view, because of this and because of another study I'm about to show you, I decided not to take a trade going into Wednesday. Now, if I did, could have made a little money. The S&P actually closed up, I think, less than a point, but it was down below where it started the day. It was, we had the afternoon wiggle. My other concern was the fact that we were going into a Fed day, and there should be some volatility after the announcement. So I shared another study that looked at a seasonal edge, and Navigator will often publish seasonal edges as well, special studies. And this special study looked at Fed days. Now, Fed days have long had a bullish bias. You can create any kind of conspiracy theory you want around that. But the general reaction to Fed news over time has been up. And what we're looking at here is since 1982, tomorrow is a Fed day. We're going to buy the close and we're going to sell the next day's close. This does not include commission. This is just a study, okay? So this shows how the market has performed over that time period. Pretty awesome. A lot of times, not as much these days, but in the past when we were in crises, part of the Fed's job would be to calm the markets. And so they would often say calming things when the market is struggling. Market's obviously not struggling when you're at a 20-day high, right? So let's take a look at, and we were at an all-time high on Tuesday. Let's look at Fed days when you're at a 20-day high. And this is it. From 1982 to present, it showed no edge. I guess you could say slightly bearish edge, but really hardly anything over a long period of time. All right. Now there weren't a ton of instances, but still, it didn't look anything like the previous chart and suggested that at the very least, the Fed day edge was not nearly as strong, being at a new high. So that was another kind of warning flag to me that, hey, the edge maybe not as strong as the odds were suggesting, because of the fact that we're overbought, because of the fact that we're going into a Fed day. So those are the kinds of things that go through my mind. I'm sorry, Long. I should have explained. Days where the Fed announces policy decisions. So 8 times a year, they will have meetings. Most of the time, those are 2-day meetings now. They used to have some 1-day meetings, but they'll be on Tuesday and Wednesday, and then at around 2 o'clock, most of the time, they will announce any policy changes. So they might raise interest rates a quarter of a point, or they might lower them, or they might say they're not doing either, which is what happened yesterday. But often when they have had these meetings and had policy announcements, there has been a reliable or semi-reliable bullish inclination. Yeah, Sri, that's not a system that you would trade by itself and not trade anything else. So that's an example of a small edge that you can take advantage of, only possibly 8 days a year. Knowing small edges like this, you can adjust your trading plan for special situations like this. Richard has a question about shorting systems. I'll get to that in just a second. That was my last slide. So I saved 5 minutes here, 4 minutes, 3 minutes for Q&A, and I'll try and get through these questions as fast as possible. So you set up for a buy and sell after the market and looking for the prior day price move. Yeah, for the most part, when we're swing trading, all the swing trading systems I showed here are overbought, oversold type systems. So if the market's selling off, we're looking to get in. If the market's overbought, I didn't show any short systems here, but as we discussed, in downtrends you can make money shorting as well. It is harder in uptrends because you get slow grinds higher. Shorting systems should be more profitable because instruments fall more rapidly in general than climb. I believe you're referring to, yeah, and below the 200-day moving average, Richard is asking. Interestingly, when you're in a bear market, there really is opportunity in both directions. Volatility goes both ways in bear markets. It's not, it's never a slow grind lower. Like in a bull market, you get the slow grind higher. Bear markets, tend to be a lot more emotional. So you'll hit oversold and it will be a stronger move down, and then it'll be a stronger move up. So you'll get these short covering rallies where you'll have very strong moves off of the bottom. So there are definitely long opportunities in bear markets, and there are definitely short opportunities as well, as you would expect. So yeah, you can, bear markets are not a bad thing for swing traders. You do need to take position size into account because of the fact that all moves are likely to be higher, so you're going to need to deal with the higher volatility. More opportunities for profit, more higher chance of a larger loss in a bear market. Looks like that was the last question coming in. Thank you so much for having me. People can email me at rob@investaquant.com if you have any questions.